Happy Friday and welcome traders. I am Rachel Deshelle, Senior Manager of Trading Services here at Charles Schwab and your host for today's Advanced Charting Techniques webcast. I am joined in the chat today by my friend and colleague Scott Thompson. Please feel free to chat in your questions, comments, requests during the session today. I'll be sure to keep an eye on those throughout the webcast. And please give us both a follow on X. He is Scott Thompson CS. I am Rachel Dash CS. We post a lot of charts, a lot of market updates, and things like that. Some exciting things for your feed there. And please like this video today if you do find it useful. Please also subscribe to our Trader Talk Schwab coaching channel here on YouTube. Now, I am super excited to be hosting this webcast today. You guys know how much I love technical analysis and charting. And I'm going to bring a new concept that I don't think many of our coaches necessarily teach on too frequently, and that is Elliott wave theory. So today we're going to go through the basics of Elliott wave theory. I will be hosting this webcast, not next week, but for the next couple weeks as Cameron May is out, and I think he's on his sabbatical. I think Scott, you can double check me on that. But I will be hosting this webcast for the weeks to come. So I think that would be a great time to dive into more of some of the concepts of Elliott wave. But today we're going to start with some of the basics. So before we get started, let's cover some of those important disclosures here. So this information that we're going to cover today is for general and informational educational purposes only, should not be considered any type of recommendation or advice. Keep in mind, options carry a high level of risk and are not suitable for all investors. And we are going to go through the paper money software application. Keep in mind that there are some major differences between paper money and live. So keep that in mind. Now for our agenda today, we're going to talk about how to implement technical patterns, in this case waves. We're going to discuss pros and cons of various technical indicators. We're going to teach you about a new one today, and we're going to look at some examples on the chart. So let me just kind of start with this whiteboard because we're going to draw a couple different things, some examples. We're going to talk through what Elliott wave analysis or what Elliott wave theory essentially is. And what Elliott wave is it's built from the concept that the market moves in waves. So when you think about a wave in the ocean, you know, the wave comes crashing to the shore and then it pulls back a little bit and gets ready for the next wave. And so the market kind of works in the same fashion where you have a strong burst in one direction, you have a little bit of a give back, a little bit of a pullback, and then you have another strong burst in that direction. So that is why Elliott wave was essentially created. It's to kind of relate to the market waves, market cycles that we see time and time again in the markets. And the basic kind of pattern that you see in Elliott wave theory, I'm going to pull up my drawing tool here to be able to kind of annotate this, but essentially a full basic Elliott wave cycle is 8 waves. So it's essentially 5 motive waves. So 5 waves in the direction of the trend. That's what a motive wave means. And then we're going to have 3 counter trend waves, which are a corrective wave. That completes a full cycle. So I'm going to show you a little bit about what that looks like. So this is wave 1, wave 2. Okay, so this is wave 1, 2, 3, 4, 5. Okay, so that is a motive wave. You have waves 1, 3, and 5 moving in the direction of the overall trend, and 2 and 4 here, the pullback waves, are corrective waves here. So this is a motive wave that goes in the direction of the overall trend. So this by itself is one full swift move up, okay? Then you have a corrective wave. So you have A, B, C. So this is A, this is B, whoops, and this is C. So this is what a full Elliott wave cycle looks like. So any, I guess, like primary moves or primary waves in the direction of the overall trend. Those are motive waves again. Those motive waves can either be impulse or diagonal waves. We'll talk about some of those as well, but those are always labeled by 1, 2, 3, 4, and 5. So that is a full motive wave there. Corrective waves are always labeled by A, B, and C. So you can see that waves A, which is this one that I'm pointing to right now with the pen, and C are in the direction of the correction. B is kind of like a counter trend type rally wave. So this is essentially what makes up a full Elliott wave cycle is these 8 waves. Again, 5 motive, 3 counter trend waves. Now, a lot of these waves, this is where kind of Fibonacci retracements or Fibonacci mathematics really comes into play here with various waves. And this is because a lot of these waves you can subdivide into smaller waves. So with each of these waves that we see here, like if you take for instance this wave 1 that you see, this itself is an impulse, meaning that it is a strongest form of a motive wave that moves in the direction of the overall trend, and this could have a 5 wave count within it as well. So you can see that the market may do a little bit of that on a smaller time frame, and in this corrective wave that you see here, wave 2, you will see another 3 count, 1, 2, 3. And then the same thing here, 1, 2, 3, 4, 5 and then 1, 2, 3. So that's kind of how the market will move in kind of those smaller degrees. You have those subdivisions there, and each of these has a little bit of rules. So Elliott wave theory, just like a lot of practices within technical analysis, it is a art, not necessarily a science. But just like technical analysis, when we think about price patterns and certain rules and things like that that justify a certain formation or certain price action, there are certain rules that come into play when it comes to Elliott wave theory. And so I want to actually go through a few of these. I'm going to clear out this drawing right here. Let's get rid of those, clear all my drawings, and we're going to get out of that tool. And so we're going to talk about some of the rules with impulse waves or some of these motive waves that we're seeing. And we're going to go through a few different examples of these. We're going to show you this on the chart as well. So something that you should know about those waves that we're seeing, some of the rules with impulse waves, is wave 2 never moves beyond the start of wave 1. So when we saw that little drawing to the side, you could see that wave 2 is a corrective wave. And a lot of times it does make a deep retracement of wave 1, but it never moves beyond the start of wave 1. So when you're doing your wave count, these are some rules that we want to keep in mind. So we're going to kind of keep these in mind before we go to kind of like a live chart on the S&P 500. So wave 2 never moves beyond the start of wave 1. However, when we look at Fibonacci retracements, we can actually see that typically wave 2 retraces a large portion, nearly 0.618 of wave 1. So that's where your Fibonacci sequence kind of comes into play there. So when you draw a Fibonacci from the start of wave 1 to the end of wave 1, it will give you some resistance or support levels to the downside. We'll kind of show you that as well, where wave 2 may retrace quite a significant portion of wave 1. So keep that in mind. Now, another rule that comes into play here is going to be regarding wave 3. So wave 3 You saw that as the middle wave. So we had wave one, wave three, and wave five moving in the direction of the overall trend. Again, two and four are corrective waves. Wave three, which is that middle impulse wave, it is never the shortest motive subwave. So it is never the shortest motive subwave, but it does not have to be the longest. Does not have to be the longest. Okay. So typically, so you'll never see it being the shortest subwave, but sometimes it doesn't happen with it being the longest either. Now, a lot of times in stock markets, you will have wave three typically being the strongest or longest wave. So that's typically what you see there. In commodity markets, you typically see wave five as the longest wave. So just kind of keep that in mind. So wave three in commodities markets is typically the second shortest wave there. And then the third rule is wave four, which we saw that correction in wave four, it never enters the price territory of wave one and wave two. Because if it never enters the territory of wave one, then it's also going to never enter the territory of wave two. So I'm going to draw this again so we can just kind of look at this example once again. So this is going to be what a wave count looks like. Okay, so 1, 2, 3, 4, 5. Okay, and you can see in this picture, I drew wave one as the shortest wave because we know that wave three cannot be the shortest wave there. We also know that the wave four, see how the edge of wave four does not come down towards wave one or even wave two? So that seems to be higher than that. So this would be a correct wave count. And then wave two never moves beyond the start of wave one. So you see it may correct a large portion of wave one, but never moves beyond the start of that. So these guidelines can help you with the subjectivity when it comes to Elliott wave analysis because there's so many different ways to count these waves. There's so many different types of wave patterns when it comes to motive waves, corrective waves, and things like that, which we'll get into in later sessions as well. But I want to go through a couple different examples, and I want you guys to tell me in the chat whether this is a correct wave count or not. So I'm actually going to go to the Thinkorswim platform and we're going to go through a couple different examples. So I'm going to get rid of those drawings there since you guys have seen the drawing for a little bit. Now, before I go into the wave count, I wanted to show you guys something interesting, a new indicator that, not necessarily a new indicator, but an indicator that may be new to some of you guys that may help with your Elliott wave analysis. And this is going to be this Elliott oscillator down below. So if you search in the studies window here and search the word Elliott, you will see Elliott oscillator being the first one that will populate. And this is really the only kind of helpful guideline when it comes to Elliott wave analysis that we do have in Thinkorswim, which is why I'm kind of going through the steps today. You'll have to use the text notes on the chart to do the labels yourself. I talked a little bit about how to label your waves, but these rules mixed with this Elliott oscillator could help you possibly be able to kind of see where these waves possibly start. So the first kind of thing I want you guys to notice about these Elliott waves, because this is kind of where we're going to start our drawings from, this Elliott oscillator, it's essentially going to take the difference between two moving averages. So it's taking a 5-period moving average and a 35-period moving average, and it's creating the histogram between the two. Almost kind of like the MACD does, where you see those two MACD lines, and then you see that histogram in the background, which is basically essentially just the difference between those lines. When the 5 period is much greater, you're going to see a larger degree, a larger frequency on the histogram, and when the separation between the two is getting tighter and tighter, you're going to see that histogram get lower and lower here. So a couple things about this Elliott oscillator. One of the things to note, and I'm going to just put this as a text note on the chart so you guys can see this. Number one, the first thing that you need to know about this Elliott oscillator is the highest or lowest value of the oscillator might indicate a potential wave 3. Okay, so that's going to be kind of the first point there. So the highest low of, or the highest or lowest value of the oscillator might indicate a potential wave 3. So whenever you're seeing a high here or a low here, that could be telling you that that could be a wave 3. Okay, now second thing that we are looking at here, if we're going to look at the second thing, the oscillator pulling back to 0 is considered a signal for wave 4. Okay, so I'm going to put that right next to our other rule here. So the oscillator pulling back to 0 is considered a signal for wave 4. So when you see this oscillator that pulled back to 0 here after this move in the S&P 500, kind of where it hit 7,000 for the first time, it consolidated a little bit, that could have been our hint to our wave 4 in that case, okay? So that could have been our hint to our wave 4. So we've already seen this could be a possible wave 3, kind of the start of wave 3. This could be the possible start of wave 4 because you're seeing that pull back to that oscillator there. Now, the next thing, the last thing that this oscillator is telling you that can help you kind of identify some of these waves is when the market is making a new high, but the oscillator fails to make a new high, it may be a signal for wave 5. Okay? So I'm going to put that there on the chart as well, put that a little bit smaller so you guys can see it. When the market is making a new high, but the oscillator fails to make a new high, it may be a signal for wave 5. And I'll put that down there so you guys can read that a little bit better. Okay. Okay, so now you have that on the chart. So this is, again, the rules around the Elliott oscillator and how to identify some of these different areas. So I'm just going to look at the past 3 years of data here, and we're just going to use this as an example. Okay. And we're going to talk through some of these waves, talking about the rules that we have already discussed, just about wave 2 can't retrace more than the entire percentage of wave 1. We talked about how wave 3 cannot be the shortest motive subwave, and wave 4 can never enter into the price territory of wave 1. And I want to talk about more about the Fibonacci retracements within this section as well as we start to measure out these waves. But I do want to take a look at the questions here in the chat. So let's see. Yeah, someone asked about the Elliott oscillator valid for all time frames, and Scott answered that question, but I just want to let you guys know any oscillator, any indicator that you're going to see in Thinkorswim, it's always going to conform to the time frame that you set it to. So if you're doing this on a daily chart, if you're doing this on a weekly chart or a monthly chart, this is useful in all of those scenarios. And because Elliott wave theory, we talk about how the market moves in waves, and these are sometimes super cycle waves because there's a grand super cycle, and there's a super cycle, and then there's the cycle, and then there's the primary and the intermediate and the minor and the minute. So every time you go down to a different time frame, you're going to see waves of a different degree, and these are all going to show up in these price trends of the chart. So let's just take a look at a couple different examples of what could possibly be wave one, wave two, wave three, wave four, wave five of the S&P 500 over the last couple years. So let's take a look at maybe an area where we could start this move, because we talked about some of the different areas where, hey, this may be a wave four because we did see that pull back to the zero line and it was kind of a large retracement there. This could be another possible wave here, another major corrective wave. And we're in a motive wave right now as well. So the market is going in the direction from the lower left to the upper right. So this is definitely motive waves, impulse waves. This is kind of the part of the cycle that we are in. If we actually looked back to, let's go back 5 years. This essentially in 2022 was a large corrective wave. So that was a major corrective wave that we saw where the market was impulsing down in a certain direction. So we're going to stick with the last 3 years and we're going to look at some of these different things. So what I'm going to do is I'm going to just take a look and spot some highs and some lows. So I see the lows for this period right now is the lows of October of 2023. And again, this is an art, not a science. You may identify different waves, but we're just going to use this as an example and kind of talk through some of these counts. So if I'm going to take this from wave one, I'm going to look all the way here from the lows and I'm going to go to the highs from what we saw there back in 2025 before we had a little bit of that correction there. And if I look from the start of that wave, we can see that that corrective wave, possibly wave two here, retraced a large percentage of that wave one. So you actually notice if we take that Fibonacci from lows to highs, it shows us our retracement levels or our support levels to the downside here. And typically with wave two, it typically retraces about 61.8% of wave one. Now it can retrace even more. It can make even a deeper retracement. The only rule is that it doesn't retrace 100% of wave one. So, but typically this is what you see is a 61.8% retracement. So this is how the Fibonacci's can essentially help with identifying some of these waves as well. When you measure them from lows to highs, you can see how far the correction actually occurred. And in this case, this could be telling us that this entire impulse on the way up is a wave one, and this is a wave down to the downside. And I want to talk through a couple things with that as we label it. So I'm going to label this from the lows to the highs in this case. And I'm just going to mark this as 1. And you always put the number at the end of the wave there. And we're going to label this as wave 2. So we're going to make that wave here. Okay. And if you notice here on wave 2, we talked about wave 2 being that 3-wave corrective wave. So if we look in the corrective wave, we can actually see there was a low here. So that would be your A right here. You have a counter trend rally. So that would be your B. And then you have C all the way down here. Okay, so corrective waves happen in 3 waves. Motive waves happen in 5 waves. So this is your A, we're just going to label it A, B, and C down here. Okay. So, let me know if you guys have any questions there. Josh mentioned adding zigzag high-low indicator may be able to identify the waves. Good point. So that is another one. Zigzags are a type of corrective wave. We will get into some of those later in the coming weeks. We're going to keep it really basic for this first one so that you guys kind of understand the wave counts, and then we'll kind of get into some of the nitty-gritty there. Let's say, Paul, the best number of candles for this. Let me know what your let me I don't know what you necessarily mean by that question. I think maybe Scott can kind of help out with that one too. I use candlestick patterns in this. Some people will actually use line charts as well. I don't know if that answers your question. And then I see Art. It's easier to identify the past. How do we identify future waves? Well, identifying the past is what's going to tell you what current wave you're in. So we're actually going to get to that here shortly. So we already talked about how this is a wave one. But if we talk about how to label this one, I want to show you guys something here. So I'm going to label this and you're going to tell me if this is incorrect or correct. If knowing that we have all the other rules that we had with these waves. Hang on. Okay. Okay. So I just labeled that one. And so this is a 5-wave pattern. Tell me if that is an incorrect or correct way of labeling it. I want to hear you guys in the chat. You got to remember those rules that we talked about in the beginning about wave 1 and wave 2, about wave 3, and then wave 4. So tell me if that is correct or not. And we're going to make it. Okay, so I'm getting a mix. I'm getting a mix. I see Chris and Kevin mention wave 3 is not the longest, but that's not the only issue here, right? It's not the only issue. So, yes, those of you that said this is incorrect as far as labeling 1, 2, 3, 4, 5, you are exactly right because one, wave 3 can never be the shortest. So we already talked about that. So we know that whatever wave this is not wave 3. This is not wave 3. So it cannot be the shortest motive subwave. Now, the other thing that we notice is this is wave 1, or what we're saying is wave 1, and this is wave 4. And we know that wave 4 can never enter into the price territory of wave 1. The only time it does is on a leading diagonal or an ending diagonal. So we'll talk about that a little bit later. But in a impulse wave, you're never going to have wave 4 enter into the price territory of wave 1, which this one does. You can see it actually retraces into the price territory of wave 1 and wave 2, which we said is kind of one of our rules there. Now, wave 2 really made a very, very shallow retracement. So this can't be wave 2 in this case either. So that cannot be wave 2 in this case. So we would have to look at different wave counts in this type of formation. So we're going to remove those. And I'm glad you guys participated with me in that. And hopefully that kind of gives you a good guideline of, hey, where I want to label things or where I can label things as a impulse wave and where I can't. So that's kind of some of the rules here on this one. Okay, so let's talk about a little bit about wave 3 now. So we mentioned how maybe the lows of this could be a start of a wave 3. And so if we actually take a look here and we go from the lows of the corrective wave, whoops, we're gonna have to move some of these around. Okay, whoops. Bear with me, guys, here. Okay, so that's A, B, C. Now, let's just say that this could be the third one, because if we look at the highest or lowest values of the oscillator, in this case, since this is an impulse wave, a bullish impulse wave, we're going to look at the lowest value of the oscillator. That could tell us that it might indicate a potential wave 3. So the start of wave 3 starts at the end of wave 2. So we're going to start there and we're going to go all the way up to where we had those highs. Okay, so wave 3 all the way up there. And that's also when we started to have that crossover of the zero line, which could be that signal for wave 4, which wave 4 would be that corrective wave here. And so if we look at this, we can actually see on this wave 4 we can see that wave 4 does not enter the price territory of wave 1. So this could be a wave 4. And it's a shallow retracement of this wave 3. So let's actually test it with some Fibonacci's. And I will say this, so with wave 4, it typically retraces a very shallow amount, possibly 0.238 times that amount or 0.382 times the initial wave 3. So if I take it from lows to highs and I look there, it didn't even pull back all the way to that 38.2% retracement. So that made a pretty shallow retracement. Could be significant enough for wave 4 in that case. So I'm going to remove that there. And we're going to label a couple of these. So we're going to go wave 3. Just going to label that a 3. And we're going to label this a 4. And so, Art, you had a question about looking historically versus looking now. And so let's talk about what we're seeing now. Well, if we know that this is a wave 4, we know that we could possibly be in a wave 5. And so if we take a look at wave 5, we could say that wave 5 could end here or it could keep going. But we know that in this case, we know wave 1, or I guess let's kind of go through it again. Wave 2 retraced a significant portion of wave 1. So it retraced about 0.618 times wave 1. Wave 3 is not the shortest wave so far. Wave 5 is. So we know 3, it's kind of following our guidelines. Wave 3 is not the shortest motive subwave. And we know wave 4 never entered into the price territory of wave 1, which was those prior highs in 2025. So everything's looking like it is aligning so far. Now, a couple different things with these waves. We talked about in the beginning how in stock markets specifically, you will typically have an extended wave 3. Sometimes you get an extended wave 1, but typically you see an extended wave 3. And here you're not necessarily seeing an extended wave 3, but it is still not the shortest wave. In commodities markets, which typically like to trend for longer periods of time, you do get quite a bit of an extension or an elongated wave 5. So it's not really typical that this would be the longest wave. We know that it really can't in this case, because if it is the longest wave, then this invalidates our completely our wave count here, because we know that wave 1 was longer than wave 3. So this could end up being a much shorter wave 5 in this case. And we could also use kind of what we're looking at here with this oscillator as well. We keep in mind that when the market is making a new high, but the oscillator fails to make a new high, it may be a signal for wave 5. We know that price right now is getting really, really close to making a new high. We know the oscillator is actually diverging from this quite a bit. So the oscillator actually made a new high back on May 12th. And when the price of the stock, or when the price of the S&P 500 made a new all-time high, the indicator was actually making a little bit lower high, which is tending to be what you're kind of seeing right now. So this could be that wave 5. So that's why when you look historically and you count these wave counts in a certain cycle that we're in, you want to keep in mind where you are currently at in that particular cycle. And that's going to tell you a lot about where to take profits, where to cut losses, some of those different things there. So a lot of traders will tell you that the best waves to trade, especially in the stock market, because they're elongated waves, will be that wave 3. The best waves to trade, like we talked about in commodities markets, because the wave 5 tends to be elongated, that's typically the best wave to trade from a trader's perspective. So when you're kind of thinking about some of these impulses, just kind of keep some of those things in mind. Let's take a look here. Someone mentioned, okay, there is no ABC in wave 4. So that kind of gets into some of the different types of corrective waves that we could see. So I kind of want to touch on a little bit of those as well. But something else that I want to touch on too with these waves is you could also use Fibonacci retracements not only in price but also in time. So something that I know I don't talk about too frequently in a lot of the classes I host is using those Fibonacci time extensions. And that may tell you a little bit about where you're at in that wave cycle. So what I'm going to do is actually go back to this wave. I'm going to do the start of wave 3 in this case, and I'm going to use the Fibonacci time extensions. And it's basically just this one with 3 lines in the background and with the little time clock here. And so if you just kind of start here at the start of a wave, it's funny. This will kind of give you an indication of where you could possibly see the end of those waves or those corrective periods start. And what's interesting is when you look out, you can actually see that this one marked a little bit of a short-term high. This one marked a little bit of a short-term high. This one was a little bit late, but you can see it kind of happened within that fourth wave there. So that could be another way where you could kind of sense if this is a, let's say, an elongated wave 3, a lot of traders may have expected it to last almost to this point to mid-March in that case. So, which still would have benefited traders who were still in that trend trade to the upside because price necessarily didn't really break support at that point. Now, if we take a look at maybe doing that for our current wave that we're in, let's take a look at this current possible, we're saying possible wave 5 that we started here. We're going to take a Fibonacci time series here and see how far this wave could possibly last. Whoops, the wrong one. So time series, and we're going to go forward in time. Okay, so if you guys look forward in time, we could say that wave 5, we actually just made a new a high recently on this Fibonacci time series, but this could tell us that wave 5 could actually take us all the way out to here, out to mid-June or so. So that could be a wave 5, or this could even be the start of a corrective wave in this case. If we wanted to add a little bit more time, let me add a little bit more time to the side so you guys can see. We're going to actually put this out a little bit more, see what the Fibonacci time series tells us. Okay, it's only going to show out that far, but this could tell us that the current wave 5, if it was going to be maybe an elongated wave 5, this could last all the way out to mid-June in that case. So that's kind of what we're looking at there. And yeah, Scott, thank you for answering that question there about how none of this is predictive of the future. So everyone kind of thinks, especially those that do not use technical analysis, they may think it's some hokey pokey way of predicting the future, a way to have a crystal ball or something like that. We know as traders that that is not the case. We know that technical analysis does not teach us how to predict price action, but it teaches us how to react to price action. So it's reaction versus prediction. We are not predicting, we are reacting, because this tells us that if we do have the end of a wave 5 here, if we do have the end of a wave 5, we may go into a type of corrective wave. And so we can use some of these methods like Fibonacci retracements and some of the other technical tools in our toolkit to be able to manage risk accordingly. So let's just take a look at an example. We did a Fibonacci time sequence here, and let's just say we went from lows to highs in this case, and let's just say price stalled out at this level that we're seeing right now. Where could a shallow retracement possibly lead us, or where could a corrective phase possibly lead us? Well, it could lead us all the way back to a little bit above 7,000 with a shallow retracement to the 38.2% retracement. If we had a deeper retracement, it could lead us all the way back to 67.75. So that is just kind of how we're going to use some of these tools within technical analysis to give us levels to manage our risk, to say, hey, maybe this is an area where we take a little bit of profit, we take a little bit of chips off the table, or maybe this is an area where we add to a position if we see a bounce from some of these different levels. So that is kind of how you're going to use this in that case. So um, a couple other things to kind of keep in mind. Let me check my notes here. Okay, so um, we talked about like diagonals and things like that. Diagonals are going to be, they're almost like rising wedges or falling wedges. If you guys watch trading price patterns, we see some of those wedges in those price patterns. Those are the only types of waves that impulse waves that wave 4 will enter into the price territory of wave 2 if you do have a type of leading diagonal or rising wedge or falling wedge in that case in the direction of the trend. Another thing to kind of keep in mind, there may be with wave 5, you may see a truncated wave 5. And so we're not seeing a truncated wave 5 in this case. In a truncated wave 5, I'm going to show you exactly what that would mean. Would be that after wave 4, if wave 5 went all the way to here, to the top of wave 2, or the top of wave 3, I'm sorry, and failed to move beyond that before moving back down, that would be a truncated wave 5. Okay, so that is a pattern that looks a little bit like a double top. It's followed by a swift and sharp reversal there. So when you do see a wave 5 and it starts to truncate out at that level, at the same level as that third wave, beware that you may see a swift and sharp reversal in that wave 5 because truncated wave 5s are known for those types of reversals. So just a couple other nuances there. I had a couple questions about corrective waves, and I want to cover those and save those for another webcast in the coming weeks because there's many different corrective waves that we can cover. We have sharp or sideways corrective waves. So we have zigzags, we have flats, we have triangles, we have combinations. So those are another beast in themselves. But I want to keep an eye on any questions that you guys may have with the last 2 minutes here. Let's see. Okay. Chris asks, will the subwaves appear on the intraday charts to validate the waves on the daily, or must they appear on the same time frame? Yes. So sometimes if you don't see the waves appear on the longer term chart, a lot of traders will piece down to the smaller time frame charts. So you may look at 4 hourly bars or hourly bars and it'll show up there for sure. Because you'll see these waves all throughout. So if I look at the S&P 500 here in this case and we just look at the last, let's say we just look at the last 20-day hourly or so, you can make a case to say that you can kind of formulate some different waves here, and maybe this is a wave 1, this is a wave 2, maybe this is a wave 3, maybe this is a wave 4, and maybe this is a wave 5. We know that 4 doesn't enter the price territory of wave 1. We know that wave 3 is not the shortest wave. We know 2 retraces a significant portion of wave 1. Let's just kind of do that little thing. Oh, look at that. Look at the math. And then we also know that there are corrective waves. So this could be a little bit of a corrective wave that we're seeing here. We had that move down. We had that little counter trend move up. And then we had another third move down. And then ever since, the market's been impulsing on the way up. So that's just kind of an example, Chris, to answer your question about just how these corrective waves, how these motive waves can show up on shorter time frames as well. So hopefully that helps. And yes, Elliott wave analysis can be used for individual stocks too. We're going to get into that, show you some of the corrective examples back in 2022, 2023. I think I have a lot of good examples from those that would provide some good corrective waves here. So you guys, I know this was a ton of information. I'm going to pull up this Word document from the last minute here as we go. Scott, thank you so much for all of your help in the chat with answering all the many questions that we had. Thank you all for your engagement in the chat. If you did find this useful, please give it a thumbs up because we want to help other traders find this information as well. We know that Elliott wave theory has been something that you guys have been asking me about for a while. So I'm very excited for the next couple sessions that I host with you guys on this Friday to just kind of cover some of those concepts. Now, also please subscribe to us on Trader Talk Schwab Coaching. Please follow Scott and I both on X. I'm Rachel-CS. He is Scott Thompson CS. And I hope you all have such a fabulous weekend. Enjoy your time. Have a good day.